All right, welcome back to the show. Today we got with us Laurence Yang. Laurence, welcome to the show. How you doing today?
I'm good. Thank you for having me, Bridger.
This is going to be a fun episode. So Laurence is calling in from Australia. And actually, we first connected. You reached out and said, Bridger, your story sounds a lot like mine. You started your first fund, I believe, when you were 22 years old. Is that right?
That's correct.
22 years old, launched another fund, just launched a third fund, and you're 26 years old now. Currently has right here on his website, $85 million US under management as of June 14th, 2021, which is incredible. So I was like, we got to bring Laurence on the show. He's a young guy running a hedge fund out of Australia. When with that resume, we got a 26-year-old kid. And I say kid, I'm the same age as you. I'm used to talking to guys that are 40, 50 years old on here, managing 85 million euros. You're the chief investments officer. You're the founder of this. I'm excited to hear your story. We're going to hear about how you've raised money, how you brought it together, your trading, all that kind of stuff on this episode. It's going to be really fun. What are you primarily investing in? What kind of categories do you go after, and what types of trades do you make?
So diversification is the key. That saying never goes old. So the flagship fund, the one you're talking about, is called a premium investment fund, the euro-denominated fund. We primarily invest in 5 different asset classes. So equity, that includes large cap stocks on NYSE and NASDAQ. And we also invest in equity index, indices futures, S&P 500, the Dow, the DAX from Germany, Nikkei from Japan. So that's number 1. And number 2, we invest in foreign exchange, Forex. And number 3, we invest in more or less crypto futures, like Bitcoin. I think Bitcoin is the main one for crypto. Only recently, but to a much less degree. Maybe we, trade Bitcoin once, twice a year. And the next one will be treasuries. So we trade ZN, the 10-year note futures from the US, and also ETFs.
Wow. And you mentioned future. Are most of those asset classes futures, or do you buy regular equities? Are you trading options on those? Doing all the above? What are you primarily doing?
We do derivatives. So let's say for commodities, we use commodities futures. And for single stocks, we use single stocks CFDs. I know CFD is banned in the US, but in Europe, in Australia, CFD is very, very popular.
Really cool. Take us back a little bit, Laurence. How did you get into this? Tell us about your story of getting into trading, and then not just getting into it, because a lot of people test out trading. How did you actually get into it and then scale up, raise capital, and decide to go after the fund?
Right, sure. So I founded Laurence Holdings Group in 2017, and at the age of 22. And 10 years before, I founded my company all the way back in 2007. When I was 12 years old, I witnessed my mother, who's a doctor and traded stocks only as a side hobby, so it's not a full-time. And she 5-folded her portfolio in just over a year. So 2007, we had a major bull market before that. So that success story served as my early inspiration. So I started reading and educating myself on trading ever since. So 2007, I was 12 years old. And then I have to admit, my starting point as a trader was pretty bad. In 2012, I started paper trading, demo trading, basically trading with virtual fake money.
And you're in high school at this time, right?
Sorry?
You're in high school at this time, right? How old are you?
2012, I was 17. Yeah, high school, 17, more or less.
Okay. Yeah.
Yeah, I studied paper. So I traded with, started with 100K virtual fake money. I was running the account with like 50 times leverage trading oil. And I tripled my account in just over 2 weeks. And I thought I was a master of the universe. And with that mindset, so I just borrowed 20K US, from my mom, real money, to start trading. I said, Mom, I've got this amazing trading strategy. I'm the best trader in the world. I was born to be a trader. And what happened is I lost 15K out of the 20K, 75%, 3/4 of that money in, I believe, less than 4 days. And it was crazy because I was running real money with leverage. And then when we have a big floating loss, I started getting nervous. I closed the position way too early. So, I realized when you start trading real money, the emotions kick in. And it's a completely different story. Like it's
why is that? You hear that? That's actually a common story you hear from people that trade is, I was paper trading just fine. And the moment it was real money, it was completely different. Why do you think that is?
Emotions. Like, as amateurs, we start to visualize, okay, I could have done this, I could have bought a new car with this money, and you don't want to cut loss. Whereas, with paper trading, it's fake money, just a number. And that's exactly how you should approach your real account. No? Like, just a number. It's not money. Don't visualize it.
Fast forward to when you were 22 years old, when you went out to raise your first fund, how much did you raise? And how, was it friends and family? Where'd you go to? Did you raise the money? Did you have somebody else help you raise the money? How did you go about raising that first? When I see the first audited financials, it was about 15 million. Is that correct? Or how much was that first big raise?
So what happened is 2016 Christmas, I was in Germany for Christmas. I went to the Christmas market, and then a friend of mine, his uncle works for the embassy, and then he said, "Hey, Laurence, I heard." My friend Justin said, "You are a very good trader. Hey, I'd like to introduce you to a friend of mine, and he is the manager of a multi-billion-dollar family office here in Europe. Like, would you like to meet him?" I said, "Hey, sounds good." And then I actually went there and meet him. And then after I met with the CIO of the family office, he said, "Hey, Laurence, you should meet my boss." And then he introduced to his billionaire boss. And then we actually started with a managed account of this European billionaire, which for privacy reasons, I wouldn't mention too much about his details. But we started with a 5 million USD, not euro. Like, he said, "Hey, Laurence, I've got this $5 million trading account. And I deposited money and it's not doing so well. Would you like to take it over and just trade on my account?" So I actually I didn't start a fund. I started as a managed account.
So for don't know what that is, explain to us what a managed account is. You're logging in essentially as a user into his account and just making trades for him on his account. Is that correct?
That's correct. Exactly right. So ever since Bernie Madoff and, his big scandal, the $65 billion Ponzi scheme collapsed, a lot of people, especially institutional investors, they demand separately managed account. They want to have, SMA, separately managed account. They want SMA to have direct ownership and transparency. So that's a very good way to get started. Even before you you start a first commingled fund or incubator fund, I think a managed account is a very good way to get started.
And then from there, it was you've just gained more investors since then as an open-ended fund model. Is that correct?
That's correct. So we actually signed up the third investor in 2019, and that's about it. 45 million euros, 3 investors and myself.
Wow.
Yeah. So
that's amazing.
So it's not about how many investors you should have. We only take, not only qualified investors. I prefer the word. Our primary market is individuals. So they are bigger than your individual investors, who can only put 250K. But they are smaller than your institutional investors with a $250 million minimum asset allocation. They're not a good fit for us because of the AUM we have right now. So that's why I see a lot of fund managers, what I call the chasing the institutional unicorn investors. They're so obsessed. Okay, everyone wants to go to institutional investors, but if you read any reports from Preqin, every single year, institutional investors, asset allocators, they will have 500 requests from fund managers, and then they set up 10 meetings and 2 allocations. So it's fiercely competitive. So it's sometimes not a good, let's say, fit for emerging managers like us. Whereas traditionally, family offices has been the stronghold for you to scale your fund as an emerging fund manager.
There's I think right now 44 million new people have signed up for accounts in the United States. Just crazy for trading accounts. That's many new investors have entered the markets. Thoughts for somebody just starting out? I know you had your teeth kicked in a couple of times when you were starting out. Any advice to them?
No risk management. So because that's another thing I have to say. When you raise capital, especially from qualified individuals, what I say, quality professional investors, performance is not the most important thing, but risk-adjusted return is the most important thing. Let's say I can return 100% a year with an 80% drawdown. That's not very good, if you know what I mean. So you need to have no risk management. Let's say make sure the drawdowns are very low, and then remember you are running a business. as intimidating as it sounds, some people are just born to be traders instead of running a business, because a lot of fund managers fail because they don't realize they're actually running a business. So as intimidating as it sounds, some people should just go and trade, friends and family's money, because they are not good at running a business. You can be a great trader, but a very lousy marketer, and you're going to find a very, very difficult time scaling your fund.
What are a few things that you do to help mitigate the downside on your platform without giving away any trading secrets, stuff like that? What are maybe some few things we can glean from you? How do you actually mitigate the downside?
The most basic one is stop loss. Use a stop loss. A lot of people, let's say, okay, I'm a 100 lot trader, I'm a 1 lot trader. That's just BS, because you have to calculate your position size depending on your account. And then before you enter a trade, you have to know exactly where you're gonna get out. Yeah. And then that stop loss, once it's hit, because nothing, absolutely nothing, zero is 100% in the market. Nothing is 100%. The only thing that's 100% sure in the market is uncertainty. So before you enter a trade, you have to calculate your position size before, you should know exactly where you're getting out, and do not ever lose more than 2%. That's the conventional wisdom, but personally, I choose 0.5 to 1%, because even 2% is too much. Think about it, 45 million euros. Now it's 49 million euros. So if you lose 2%, it's almost $1 million. Yeah. So I always joke with my friends, risk management is so important to us. If we lose 1%, we basically lost a Rolls Royce.
Yeah.
But yeah, so number one, most straightforward is to calculate your position size and make sure the stop loss is hit. You don't lose more than 2%. Well, my suggestion is 1%. A lot of gurus will tell you 2%. That's number one. And number two is, let's put it this way. Risk/reward ratio has to be greater than 1 to 2. So your reward, your take profit, has to be at least twice as big as your risk. Let's say I want to buy Apple at $100 and your stop loss is $90. You're risking $10. Your take profit should be at least 120. Yeah. Therefore, even if you only win 50% of the time, you still can make money. Because, I think winning ratio is overrated, because you can win 90% of the time, and the 10% of the time blow your account. That doesn't say much. And I see a lot of signal providers online advertising, okay, sign up for this 80%, 90%, accuracy, like signal. That's just complete BS, because don't fall into that trap, because risk/reward ratio of 1 to 2 minimum is the holy grail to trading.
Okay. Wow. That's really cool. And if people want to learn more about you and your fund and what you guys do, where can they go to find more about you?
The website, most straightforward one.
Okay. We'll link that below. And the website is laurenceholdings.com. So laurenceholdings.com. We'll link it below as well. You guys can check it out. You can go see the audited financials and what all the stuff they do. And I think there's an investor contact thing if you guys are interested in contacting Laurence and learning more. So Laurence, thank you so much for coming on. It's been a pleasure. Thank you. I know it's early morning there. It's kind of later in the night here, but it's been fun to have you on.
Thank you for having me.
Okay. Thank you guys. See you in the next one. Bye.